Hey, good afternoon, everybody. Happy Saturday. Hello, and welcome. I figured I'd join about a minute early, let some people join in, tune in. Welcome to this week's webinar, guys. This week we're going to be going over momentum trading and how we trade momentum. And, just sort of, it's a good one. We're going to go over, what moving averages, what indicators we could use, stuff like that to help us recognize momentum, because sometimes as new traders it's hard to tell between a range and a strong move in the market. And guys, when we are able to spot momentum, it really helps us in our trading, because then we're able to get in on some bigger trades, right? So I'm talking about breakouts, not fake outs. I'm talking about breakouts with continuation, strong moves with volume and continuation, and so on. Alright guys, I am going to get started in just a minute. What time is it? We're looking at 6 o'clock on the dot. Yeah, I'm going to give it about another 10 seconds or so, then we'll get started. I was thinking maybe for the next few webinars, what I'll do is I'll pre-record them and post them on YouTube. I wasn't sure if that would be a better move, or unless you guys do like the webinars where I'm actually interacting with you guys, answering questions and such. So it's completely up to you guys if you want to drop a comment saying if you'd recommend one or over the other. But of course, as you guys know, when we do go live, they're recorded and you're able to rewatch them again as much as you would like. Alright guys, don't forget to hit that like button before we get started. Alright, let us get into it. So Trade the Momentum webinar with me, Kevin. Alright, so we're going to get into it. So momentum trading techniques and strategies. So introduction of momentum trading. Definition: momentum trading is a strategy focused on capitalizing on strong price movements driven by an asset's recent performance. So I'm talking about if Apple's making new year-to-date highs, ES is in a strong bull market, NASDAQ's also looking strong. That's something that would help us say, okay, we have the underlying markets doing well, and that's going to be ES and NASDAQ, and we have Apple at new highs. I'm going to follow this trend and take it bullish for continuation, as an example. Benefits: so potential for high returns within short periods, ability to participate in trending markets with high profit potentials. Now, when I say that, guys, what I'm referring to is when we're intraday trading, right? And something that I mention and look at often is my watch lists. And what I look for on the watch lists is I look for whichever stocks and whichever large cap stocks have the largest percent change on that day. So if I have a watch list of everything from Apple, Google, Tesla, Nvidia, Microsoft, Amazon, all of them, just, all these nice big large cap stocks, and I'm able to sort it through highest percent change to lowest percent change, everything that I see as the highest percent change is going to be relatively stronger than something that might be in the middle of the list. And everything that has the weakest percent change, which might be then red on the day, those are the relatively weaker stocks. Now for me personally, I have a set rule that if I'm looking at that watch list, I can only trade stocks that are on the top of the list for going long and stocks that are on the bottom of the list for going short. That way it tells me, okay, these stocks do have that relative strength, that relative movement. Let's see. So understanding the significance of identifying strong trends for effective trading decisions. Guys, I underline strong because I just can't emphasize it enough. When we want to trade relative strength, we want to be starting out just like we do every day, right? We want to look at the charts. We want to start off on the weekly, the daily, then we'll go into something like the 4-hour, the 2-hour, the 1-hour, and we'll see which stocks seem the strongest in that market. And if, we see continuation, if we see Apple had 3 strong green days, then I'm not going to want to short Apple. I'm going to want to follow that trend because the trend is our friend. So exploring how momentum trading differs from other trading strategies. Again, guys, this is a really important one because the market likes to range for about 70% of the time and only trends for about 30% of the time. So as I showed you guys before in previous webinars, we've gone over pivots, we've gone over ranges, so now we're able to go over momentum and trends, and those momentum moves and trend moves are really, really ideal because when we break out of these ranges, we tend to get a strong move to the upside or a strong move to the downside. Once we're able to recognize those types of trades, we're able to really capitalize on those because ranges are okay and ranges are great if you're able to sell at the high and buy at the low. But when we break those ranges, it's usually because the stock consolidated long enough to get momentum to move us higher. So exploring how momentum trading differs from other trading styles. An example, again, is buying a stock breaking out to new highs, anticipating further upward momentum. We always want to be trading with the trend, guys. We never want to trade against the trend unless we get that proper confirmation, right? So if I'm trading a stock that's moving higher, I'm going to want to see higher lows being formed, and I'm going to want to see higher highs being formed. Once we start breaking that structure and we start making a lower high, then it's sort of tough to take that trade. So let's see, what next? Identifying high momentum stocks. Just like I mentioned before, guys, what I do is I have my watch list full of 10 to 15 large cap stocks. I sort it from largest percent change to weakest percent change. So that could be, let's say Tesla's up 2% on the day, then I'm going to want to trade Tesla to the upside. And if Nvidia is down 1% on the day and it's the weakest at the bottom, I can only trade that to the downside. So criteria, stocks with high relative volume. Guys, volume is also key, guys. If we're looking at stocks and it seems to be in a range and we think it's going to get momentum, but we're looking at the intraday volume or we're looking at a previous day's volume and we're looking pretty weak, then we're not going to want to take that trade, or at least we're going to want to scalp it until the volume and momentum really does prove itself and sustain value. Significant price fluctuations and strong technical signals indicating momentum. Some good indicators to use, guys, for momentum and to see where these trends are would be like the moving averages, the MACD, the RSI, that's the relative strength index. And what these do is a lot of people will say, oh, well, the RSI, when it's above 80, it means we're going to reverse, and when it's below 20, it means we're going to reverse. I personally like to set it at 70 and 30, and what I'll do is I'll look for stocks that are above 70 or below 30, and instead of looking for them to reverse, I'm going to want to continue that trend, and I'm going to want to play it back to the upside if it's above 70, and to the downside if it's below 30. Because although RSI could signal some type of reversal without any type of divergence, we're going to want to still go with the trend. And divergence is a huge, huge key, guys, because with divergence, we're able to see, okay, well, the MACD looks divergent because the MACD created a higher low, whereas Amazon was creating a lower low. So the divergence in that would suggest there's going to be a shift in market structure, whether it's a reversal or even if it's just a pullback. So even with that being said, it would sort of hold me out of that trade because the divergence could be a shift in market structure. Just like I have, guys, if you want after this video, I do have a video on not on momentum, but on divergence trading in the Bullish Bears YouTube channel. So if you guys want to go check that out as well. But the way I use divergence is I look at ES and NQ, which is the S&P 500 and the NASDAQ. And I like to see, okay, is ES creating higher highs and is NASDAQ also creating higher highs? Now, once both of these start going a little against each other, let's say ES is failing to make a new high, but NQ creates a higher high, that's divergence that I'll look for some type of shift in market structure for us to pull back. So example, identifying a stock with surging trading volume and consistent price gains in an uptrend. Again, guys, volume is key. Watching for relative movements is key. Relative strength, relative volume, and again, even using indicators to help recognize where the strength is and where there could be weakness and where there's divergence. So just a quick note, it's always important to conduct thorough due diligence and analysis before entering trades. So so what somebody told me once, and she was actually a member of the group, was that we could make the market look like whatever we want it to look like to agree with our analysis, right? So if I want to say I want there to be divergence and I start to see some divergence, then I'm going to instantly take that trade, but it could still run against me. Using that type of mindset means that we're going to be trying to fight against the market quite often. That's also why the trend is our friend until the end of the trend. So we stay patient, we do our due diligence, we see, okay, why could there be divergence? Is there divergence because the indicator needs to breathe? Is there divergence because the markets are overall weak? Why is there divergence? You got to ask yourself, why is there divergence? Does it make sense for us to reverse here? Does it line up with our key levels, our support and resistance, supply and demand, whatever you use? to find and to help give us that extra confirmation of, yes, okay, it looks like we're getting divergence on the RSI compared to Apple, and it looks like we're also coming up to a key psychological level of 195, for example. And that's the type of trade that we could say, okay, there's three confirmations, the divergence, the key level, and then let's say even ES and NQ had divergence too. That would be three strong confirmations that would suggest we might either get a pullback or a reversal. So we would be able to then go against the trend with that confirmation. We'd be able to enter once we create a lower high, and this is for a bear move. So if we're creating higher high, higher high, higher high, let's create a lower high, enter on the lower high to go short, put our stop loss at the previous high, and be able to ride that move downwards. Because a lot of times when we do get a shift in market structure, the moves can be very volatile and very, very strong because the market wants to take all the orders. Everybody who just had gains on the uptrend, they want to take those gains away. So if we're able to exit and take our gains off the table and then reverse our trade or enter some put contracts, or if you're trading futures, trade some future contracts to the downside, then we're able to really capitalize on some type of pullback or some type of reversal. Guys, don't forget to hit that like button. I do appreciate it. Momentum trading strategies. So we could look for something like breakout trading, taking advantage of price breaking out to enter on momentum. And guys, we got to remember when we're looking for breakouts, we don't want to be in a fake out, but it's hard to recognize what's a fake out and what's a breakout. But with volume, it's able to we're able to really see, okay, well, it looks like we have volume supporting this move. Let me take this trade. Or if we're sitting at a key level for some time, that tells me that there might be liquidity holding us below the key level, but the more we're at that level, the more likely we are to break that level. Trend following strategies, staying in trades as long as the trend persists. Again, that would be using something as basic as looking at market structure of, are we creating higher lows? Are we creating higher highs? Is the market in an uptrend? Are we above our key levels? Are we in a range? And these are all things we have to ask ourselves before the market opens, depending on what stock we're looking at. Because when we ask ourselves these questions, it gets our mindset ready for these trades. And it could even get us out of trades, it could keep us out of losing trades, or it could get us prepared for a big momentum trade that maybe somebody else that we know might have missed out. So reversal strategies, recognizing momentum shifts and entering counter trend trades. Again, guys, we do want to trade with the trend, but once we start getting the confirmation that the trend is either coming to an end or we're starting to reverse, we're going to want to take a counter trend trade, maybe enter on a higher low or a not a higher low, a lower high on a bull trend, and place our stop at the previous high and ride it down to the previous low, and that would be a good trade. Adapting strategies to different market conditions and time frames, that's also important, guys. So the 5-minute, the 1 hour, the daily, these are all things that are all in the market, but each time frame is going to give us different opportunities and different setups. Now, we might be able to apply our price action to each time frame, because every time frame, if we're looking at candlestick patterns, we're able to chart on every candlestick chart. The only thing is, if we're looking at a higher time frame, those lines, those levels, they're going to be a lot stronger than if we're looking at a 5-minute range. Well, the hourly range will be a lot stronger than the 5-minute range. Risk management for momentum trading. Guys, I'm sure some of you may be a little tired of hearing me say risk management, but quite frankly, risk management is probably one of the top 2 or 3 things that we need to do consistently to consistently grow our accounts. Once we start saying, I don't need risk management, that's when we start taking bigger hits and bigger losses than we need. That's when our accounts really start taking a hit. So we don't want to be doing that. We want to be staying patient. We want to really go with the trend, and we want to take our time and really have good risk management. Know where our stop loss is before we enter the trade, know where our target is, and assess the trade. Is it a 2-to-1? Is it a 4-to-1? Is it a 1-to-1? And take it accordingly. So setting appropriate stop loss levels to protect capital from adverse price movements, calculating position size based on risk tolerance and trade setups. We never want to go too heavy. We never want to get in a trade that could go against us and could wipe out our account entirely. We always want to remember the 2% rule, that we want to stay with only risking 2% of our account size. So the importance of maintaining a favorable risk to reward in momentum trading is huge, because when we are trading momentum, guys, that means we're able to capitalize on a bigger move than we were just in within the range. So let's say on Microsoft we were in a $5 range. Once we break that range, we might get a $10 to $15 move. So we're able to really capitalize on getting that much, much larger move and taking advantage of that. So mitigating risk through proper trade management and diversification. So if we have larger accounts and we're able to say, okay, well, I want to invest some in some banks, banks are doing well, different sector rotations are super, super important to keep an eye on. I do apologize. I know the pictures are a little bland today. It's been a bit of a long week, so I do apologize about that, guys. So momentum trading tools and indicators, utilizing moving averages to identify and confirm trends is super, super important. So we could use maybe the 9 EMA and the 21 EMA, or if we wanted a little tighter, we could do the 8 EMA and the 20 EMA. And once stock sort of starts chopping in between those, we know, okay, the stock is pretty weak right now. I'm going to wait for the stock to push up, and I'm going to wait for the indicators to push up with it. So that could help us if we have trouble reading price action. Me personally, I like to just read the price action itself and go with the trend like that. But intraday, it's also good to use momentum and these types of indicators, because it does show us, some areas of support, if we're moving strong, or if the indicators are going sideways. Most likely the stock is going sideways as well, because the indicators are going to move with the stock. That's why they're called moving averages. Right? So I said, again, are we making higher highs and higher lows, or lower highs and lower lows? The lower highs and lower lows would signify a bear trend, and the higher highs and higher lows would signify a bull trend. So understanding the relative strength index, the RSI, and other momentum indicators is super, super key and ideal to helping us spot divergences, momentum shifts, and just momentum in general, right? So if we have MACD pushing bullish and it's staying bullish, we have RSI pushing above 60, 70, and it's not stopping, this is something we'd want to see for continuation in that trend. Now, once we start adding indicators as confirmations, we're able to say, okay, well, the RSI is staying bullish, the MACD is staying bullish, and we're well above the 9 moving average. Then I know I'm not going to short this stock until I see either some type of divergence, or I'm just not going to short it at all, and I'm going to buy the dip, right? We always want to buy the dip. We never want to buy at the high of day, because we never know when that high of day is going to have a pullback. And this is for intraday trading, right? So whenever I mention, we never want to buy high of day, when we look at the daily time frame, and if you're a swing trader, you could then apply that to the higher time frames. So integrating multiple tools and understanding volume analysis and indicators for comprehensive momentum analysis is super important too. Volume profile, guys, is another great tool, and I actually did a whole webinar just on volume profile itself and how I find my key levels with volume profile. And it's really good because it helps out. It helps to notice, okay, well, it looks like there's it's called a volume shelf. Do we have a volume shelf at $150 on Apple? Yes. Okay, so I'm going to look for us to break above and maybe come back and retest and hold that level. Once we come back and retest that level and hold it, I'm going to look to place a buy order there because I want to trade with the volume and with the trend. So how to adjust trading strategies based on various momentum signals. Again, guys, not every trade we take is going to be because of momentum or because we're getting a strong move or because of a trend. A lot of times the market likes to be in a range, so if we're in a range, we can't play a trend. I'm going to say it one more time, guys. If we're in a trading range and you've established that we're in a trading range, don't get in the trade expecting it to break out and trend. stay trading that range until the market proves us otherwise. Even with breakouts, guys, breakouts of ranges tend to be fake outs because the market knows we might be looking at keep going back to Apple and Microsoft. Let's say Amazon is chilling at like 120 to 130, and for a moment it peaks at 131. Now we could take that trade on the breakout if there's volume. If there's not volume supporting this trade, we might want to wait because it might end up wicking people out and catching people on the wrong side of the market. And that's also where volume profile helps out because we're able to see, okay, well, it looks like we're pushing above a volume shelf, right? Or it looks like the volume shelf is right above at 131 instead of the 130. So this could be that fake out. So we just want to be aware of where the volume is, where the larger institutions are placing their orders, because the thing is, we might not know where the institutions are placing their orders, but once we start using volume profile, they can't hide their volume, right? Once they buy orders or once they buy stock or sell stock, that volume will sit there and be there. They can't hide it. They have bought the stock, it hit the market, it's going to show on the volume, and it's going to show on time and sales, it's going to show on level 2, it's going to show on any type of order flow that you use. So chart patterns and momentum trading. Guys, I did another webinar recently, I guess a couple weeks ago now, on chart patterns in general, and these are just a couple that could help us with the potential continuation or even reversals. So bullish continuation patterns, right? We could have a bull flag or a bull pennant. That's when we sort of go straight up with strength, sort of chop a bit to the downside. Now we have to be careful when we're entering trades on these types of patterns because each time we are chopping in one of these patterns, we tend to break the previous candle's lows and wick right back up. So with those wicks are stopping people out even though we haven't had a shift in market structure, even though it's just a pullback. Alright, so bearish reversal patterns would be like a head and shoulders, where we have the head on the left side at, let's say, 120 on Amazon, the shoulder on the left side, say, at 120, the head in the middle around 125, and then the right shoulder also around 120. We always want the left shoulder and the right shoulder to sort of be in the same price area, and we always for sure want the head to be much higher than the shoulders because that's what makes it a head and shoulders. Our head is above our shoulders regardless. If we're not seeing that price action and we're sort of just chilling at the same level and it's keep just rejecting at 130, 130, 130, that's going to be either a triple top or we're in a range. So use chart patterns to confirm momentum signals and enhance trade entries. Again, guys, this is super huge because now we're using price action versus using indicators. And when we use price action, it helps us because price action is formed due to the volume in the market. I apologize if you hear the dog barking, by the way. So example would be spotting a cup and handle pattern as a bullish continuation. So a cup and handle would just look just like it sounds, right? A cup, which would be a rounding bottom like this, and then we get a little handle, which would be another little rounding bottom right near the top of that trend. Now we could take the breakout and we could put our stop at the previous lows, or we could wait for the breakout and wait for the retest and enter on the retest. A lot of times I like to wait for the retest because when we get that retest, that's that confirmation of, okay, here's the pullback, here's my stop loss, and then I'm able to really ride the trend higher. Give me 1 second. My Lucy indicator's going crazy, guys. Somebody must be walking their dog. Alright, so common mistakes to avoid in momentum trading. As I've mentioned throughout the webinar, guys, we don't want to be caught up in the wrong side of the trend. We don't want to be caught in a fake out versus a breakout. And we want to be able to recognize and avoid overtrading by staying selective to avoid unnecessary risk exposure. So once we start, it's hard to not overtrade for some people, because once we take a loss in the market and we were really confident on that trade, it makes us feel like, oh, well, we have to get back in the trade. We have to make money off this. But that's not the case. Sometimes it's best if we take our loss, respect our stop loss, and give it some time. One of the rules I tell some of our members is, once, if I'm intraday trading and I'm trading off the 5 minute and I just took a loss, I have to then sit back, sit on my hands, and wait 10 minutes, right? Wait for 2 more 5 minute candles to form to tell me either yes, we are in a trend in the opposite direction, or yes, that was a fake out and now we are going to continue higher, or even if we are in a range, well, then waiting that 10 minutes will help me stay out of getting in a poor entry, getting in a poor trade, or hitting that reverse button when I shouldn't be. So managing emotions and avoiding impulsive decisions during heightened momentum. Guys, when we get high volatility, that's when we might get good trends, but that's also when we might get good fake outs. And the market needs to grab people's liquidity, because the liquidity is what fuels the market to go higher or what fuels it to go lower. So when we have fake outs and when we have these types of trends and shifts in market structure, that's when it's grabbing liquidity to really fuel the real move, right? So we don't want to be caught up in the fake move. We don't want to be caught up in the fake out. We want to wait for the breakout, confirm that it's real, wait for a pullback, and enter on the pullback, right? Enter on either the pullback or the retest, or even try to enter at that key level with a stop at a previous low or a stop at a previous high. So addressing the psychological challenges of FOMO, fear of missing out. Guys, the market will always and never move without you, right? So the market's always moving. There's always going to be some type of trend somewhere. There's always going to be some bull move or some bear move that we may miss out, but that's okay. The market's not going anywhere. The market brings us opportunities every single day, and we just have to stay patient and take advantage of that. So the importance of adhering to your trading plan and staying disciplined. This, goes off of our previous webinar. Knowledge is incredible. Listening to you makes me feel like I've been getting lucky. Thank you, Mr. S. I appreciate that comment. I do my best. I try to make really good webinars for you guys, and I try to help out so that, you guys could also get the same knowledge that I use in the market. Because once we do get it down pat, and once we know what we know it. We don't lose that information. So that's why I always say the market will never move without us, because there's always going to be the next move. There's never a reason to be like, oh man, I missed this big move on Apple. Well, if it's a big move, there's probably going to be a pullback in a second leg. So let's wait for the pullback instead of chasing the first leg, because we might enter the first leg because we saw it move without us, but then we might enter, and then we might pull back right away, and we might be like, oh my goodness, can't believe I got in and now it's reversing on me. Then you end up stopping out on that trade, and what happens is you stop out, we're the fuel, we're the liquidity, and it moves higher. And then we're looking at almost 2 losses in one, because now we're stopping out of a losing trade and looking at the market continue, and we could have said, oh, well, I could have held longer. But in all reality, instead of holding longer, we should have been patient for the pullback. There's always going to be a pullback. There's always going to be a flag, a pennant, a pullback to some area of liquidity, some form of fake out. And that's what we have to look for and take advantage of. We don't want to be liquidity. We want to use the liquidity. All right, so tips for successful momentum trading. Developing a structured trading routine to identify and manage opportunities efficiently. So we want to stay patient. We want to wake up in the morning early before the market opens, do our technical analysis, see what stocks are opening where, and really take advantage of, okay, well, it looks like Apple's opening, it's gapped up, it just had some strong days. Let me look for a pullback, or let's say Tesla gapped up and it's looking weak at the open. Let's see if we fill the gap. And these are all different types of trading strategies and trading strategies that we could implement at the open, but we have to do our technical analysis beforehand, because a lot of times we will get that gap up or gap down, and a lot of times we will fill the gap, but also a lot of times we won't fill that gap. So we have to be careful on our entries. We can't just assume we're right. We have to go with our trading plan. We have to find a routine that fits us, and we have to find a trading plan that fits our routine, that fits our lifestyle, right? So if I'm waking up at X time, I'm going to wake up at that time every day. Routine is so important because the human mind goes off routine so well. Everybody, dogs, cats, mice, snakes, they all routine. Everything knows what it knows by routine. So once we get a strong routine of, okay, this is my trade setup, this is what I look for, this is how I'll execute. You could do that over and over and over until you see, okay, it's working 70% of the time. Now let me fix my risk to reward, right? Let me make sure my risk to reward is at least 2 to 1 on every trade. So I'm also able to lose more trades than I win, but still be a profitable trader. And then you could always work on adjusting your trades and your setups while you journal, because journaling is also key, guys, because we're able to write down, it looks like I took this trade because I was feeling emotional because we broke out of a key level, but we ended up wicking around that level. I didn't exit even though the wicks told me I should have exited, and then it reversed on me and I took a bigger loss than I should have. So we have to stay patient, we have to execute accordingly, and we have to definitely journal so we could see what we're doing right and what we're doing wrong. Because when we see what we're doing wrong, we're able to knock that out of our trading routine. And when we see what we're doing right, we're able to keep that in our trading routine and really execute it appropriately, accordingly, and continuously and over. We want to be able to repeat our trading strategy and repeat our setups and repeat our routine every day. That's why it's so important. We want to be able to repeat our trading strategy to a T. So if it's working 70% of the time and you have a 2 to 1 risk to reward, that's going to be a really profitable strategy for you. Even if it's a 50% of the time it hits, but your 2 to 1 risk to reward, you're still going to be profitable. So it's always important to have a good risk to reward and be able to go with the trends and go with the trades consistently. So time management strategies, exercising patience and discipline to wait for optimal entry and exit points to efficiently execute momentum trades. Remember, guys, once we're out of that range, it's most likely than not, if it wasn't a fake out, it's going to give us a strong trend. That range was a form of consolidation before we broke that trend. Before we broke that range into trend, and we see volume profile, we might see the moving averages, the 8s crossing the 20, or we might see intraday that VWAP is starting to rise higher, which means volume is coming into the market as well. So practice consistency in trading execution, sticking to your strategy, and avoid impulsive decisions. Guys, it's super important to avoid impulsive decisions because once we start going outside of our strategy, we can't really go off of our strategy's results anymore because then we're taking impulsive trades and trades we shouldn't be taking due to that impulsiveness. Avoiding trading during periods of low liquidity or high volatility as they can increase risk. I was mentioning to one of the members the other day how it's important that we how do I put it? So if I'm always trading ES, right? And ES is $50 a point, and I usually have a 5-point stop that's $250, and I usually have a 10-point take profit, right? So that's going to be a 2 to 1. That's great. I'm risking $250 to make $500. But once the market gets more volatile and gives us a higher range, I'll use supply and demand as an example. If I'm used to trading into demand and I buy at demand and my stop loss is usually 5 points, but let's say this range is much bigger and the demand zone is 10 points, then I might want to go to a micro and trade MES, and I'll do 5 contracts of MES, so it's $25 a point versus the $50 a point. So if it does hit my stop loss of 10 points, I'm still only losing the original $250. I'm not then losing $500 on that. Now that also applies for when we're going up to the bull side, right? And if we get in a trend that's going higher in momentum, we're able to really capitalize on that because even though we might be in a smaller position, we were managing our risk appropriately and we're able to capitalize on that larger move. So avoid trading during periods of low liquidity or high volatility, as they can increase risk. Sort of what I just went over, guys. If we do have that increased volatility, although yes, it does bring us the opportunity to have greater trades, bigger returns, we want to be careful because it could also give us larger losses. So we want to make sure we know the market context. We want to know, are we making higher highs, higher lows, lower highs, and then we look at our moving averages, and then we look at how the market is performing, and so on and so on. Where are demand zones? Are demand zones holding up lately? Are supply zones forming lately? These are all things we would want to ask ourselves before we implement any type of trade, because we want to trade with the trend. Developing a trading routine for momentum trading, designing a comprehensive trading routine and that includes momentum analysis, right? So if we're in a range, we might want to look for the higher lows, and we might want to enter on a new higher low if it seems like the stock is slowly getting higher to the top of the range and looks like it's grabbing liquidity from the top of the range. Because remember, the more we're at that key level, the more we're at the top of the range, the higher the chances that we're going to break that range, because the more we stay near it, the more liquidity we draw from it. So let's allocating time for research, charting, trade execution, and review. Again, super important. We want to be able to review our trades appropriately and accordingly, because if we can't review our trades, it means we're trading wrong. We want to be able to say, hey, look, I took this trade and it didn't work out, but that's okay because I had my stop loss, it didn't hurt my account, and my next trade, if it's a winner, because I have a 2-to-1, it's going to not only get my loss back, but it's going to give me some gains too. You know, once we start having higher risks or rewards, 3-to-1, 4-to-1, we're really able to lose 1 or 2 trades in a row, maybe 3 trades in a row, but win that 1 or 2 in a row, and then really be profitable even though we lost more than we won. And that's super, super important, guys. And when we trade options as options traders, it's hard to do that sometimes because options fluctuate differently from the actual price of the underlying asset. So aligning your routine with your trading goals and personal schedule. This sort of aligns with the routine and trading psychology webinar that we did last week, which would be on, just our trading routine, our psychology, and if something's going, like, let's say something's going on at home, we shouldn't be taking our trades. If something's going on at home that's interfering with our routine, we don't want to be taking any trades. We want to stay away from the market because our mental game is not at 100%, and we need to be at 100% to execute our trading strategy accordingly, because if we're not in the right mental state of mind, we're going to take those impulse trades, and those trades are what really eats up at our accounts. So incorporating risk management practices within your daily routine. Again, we want to wake up before the market opens and say, okay, well, it looks like Apple's above this level. I'm going to want to buy it when it comes back here. I'm going to put my stop loss at the previous day's highs or the previous day's VWAP, and we're going to want to take that trade. We're going to want to stay patient, wait for our entry, know where our stop loss is, and know that when we enter this trade, know that we're not entering too heavy, that if the market does go against us, I'm able to lose X amount on this contract. I'm able to lose X amount on this trade setup. So conducting post-trade reviews to analyze both successful and unsuccessful trades for valuable insights. So we could go on YouTube, we could join our groups, and it's really great to have a group to trade with because then you're able to learn off of them, bounce ideas off of other traders. It's hard to trade alone, but at the end of the day, we want to be journaling and we want to be reviewing our trades because the only person that could execute these trades for us is ourselves. So the only person to hold us accountable is ourselves. I'm here to always help the Bullish Bears community. We have Bullish Bears Signet, Bullish Bears Jeremy. We got a big community over here of educators that love to help teach you guys, but we don't pull the trigger on the trades for you guys. You guys do, right? So we could teach you how to do supply demand till our face is blue, but I can't teach you wait for it. I could teach you wait for it, but that doesn't mean your trading psychology is going to let you wait for it. We want to be disciplined. All right, so summary of momentum trading. So momentum trading is capitalizing on strong price movements driven by recent asset performance. Again, we want to be trading with the trend. We don't want to try to be the first buyer. We don't want to try to be the first seller. We don't want to trade in a range expecting momentum. If we're trading in a range, trade that range. Don't buy in the middle, sell at the high, buy at the lows, or wait for the breakout of the range and the retest of the range, because once we retest the range and grab liquidity, we go higher. Did we cover ways to measure liquidity of an equity? No, Spooder man, I like your name, by the way. The ways to measure liquidity. So no, we did not. That is a video I'm actually working on, is how to measure, are we grabbing liquidity? For sure, for sure. Are we grabbing liquidity? Is it a breakout? And a lot of times, so like let's say with supply and demand, for example, the way that these zones are formed is because we had some area of consolidation and then we had a big impulse move, but that wasn't just an impulse move fake out, it was an impulse move with continuation, and that's what formed that zone, the demand zone, the supply zone. And once we have that zone formed, we're able to say, okay, let me enter here, let me wait for the stock to get back here, and that zone holds liquidity, which will show the liquidity once we get back into the zone. So if, let's say NVIDIA is at $470 right now, and it had an area of liquidity or a demand zone at 450, right? So we consolidated around 450, 455, and then we had a big pump up $15, $20 to 475. Then we're going to wait for stock to come back down to our demand zone, which would be an area of interest or an area with liquidity, and we're going to want to enter there. We're not going to want to chase it downwards to it. We're going to want to stay patient until we're back in that zone, because that liquidity is what will help support our trade analysis. And there's other ways to watch liquidity as well. Is it a liquidity grab? Are we breaking the highs for a moment, and then once the candle closes, there's a big wick saying, no, we aren't, and we reverse and go lower. What that big wick is doing is that wick is trapping buyers on the wrong side of the market or sellers on the wrong side of the market, and we don't want to be trapped. We want to use their liquidity to push us the opposite direction so we could profit from their liquidity. We don't want to be liquidity. Momentum trading identifying high momentum stocks, utilizing technical indicators and criteria for spotting potential opportunities. Like I mentioned earlier, guys, when I'm intraday trading and I'm looking for equity setups, I look for the highest percent change intraday. Is Tesla the highest percent change? Is NVIDIA the highest percent change or the lowest percent change? And those are the stocks I'll want to trade because they are moving that much better than these other stocks. Momentum trading strategies using breakout, trend following, and reversal tactics for different market conditions. Do we have that divergence? Is the stock moving up clean and smoothly? Are we creating higher highs, higher lows continuously? Then trade the trend. Are we starting to create lower lows and higher highs? Well, that would be a wide range, but we would want to sort of stay out of something like that. A lot of times the market will squeeze and will create a higher low and a lower high, and a lower high, and a lower high, and a higher low, and the market squeezes, and that'll give us some type of trend and change and chart pattern as well. Because the market's squeezing, we might get a triangle pattern, or some type of decreasing, increasing volume, decreasing triangle pattern, and those are the things we want to wait. We don't want to be, if the market's sort of starting to squeeze, we don't want to trade that. We want to wait for the break, the retest, or the pullback, and we enter on that pullback. Risk management for momentum traders, setting stop loss levels, proper position sizing, and favorable risk to reward. Again, guys, we don't want to, although we might want to go heavier because the trend seems stronger, not at first. We want to take it slow, and as new traders, we would want to take it slow and even size down if we think the trend's going to be bigger, because if the trend is larger and stronger, we're still going to capitalize very well if we're in the right side of the trade. So even though we might be in a smaller position, that position can do very well for us. And once we gain that consistency, we're able to take it to the next step. Trading is all about compounding. Start with one contract, go to 2 or 3. Start with 3 contracts, go to 6. These are things, start with 5, go to 10. These are things that trading gives us the opportunity to get consistent so that we're able to then add to our strategy and go more and heavier and really capitalize on every type of trade we take. Momentum trading tools and indicators utilizing moving averages, RSI, and volume to make informed decisions. That's again super important. If we use these indicators to help us, okay, well, it looks like the RSI is pushing above 60, it's pushing above 70. Instead of looking for a reversal because RSI is getting so high, we're going to want to keep trading that trend higher until maybe we see the RSI peaked at 88 and now the RSI is coming lower, and then RSI hits 80, but Apple went from 150 to 155, so Apple made the higher high, but RSI made a lower high. That's divergence. So there could be a shift in market structure. There could be a strong pullback on Apple due to that divergence. What else? Chart patterns in momentum trading, recognizing bullish continuation and bearish reversal patterns for enhanced entries. We just want to stay on top of our game, guys. We want to know what type of trading strategies we use. We want to know what kind of price action there is to implement. We want to know what kind of ranges, what kind of channels are we in, where are our key levels, and really trade with the trend and trade with our levels and prospective zones and areas. Use volume profile to see where the large institutions are buying. Now, although the volume profile won't tell us if they're buying or selling at that area, it'll still show a large volume shelf if that area is a strong zone that there might be some type of reaction. Alright guys, I believe that is it. Thank you guys all for tuning in. I feel like that was a really great webinar. Trading the trend and trading momentum is super important, guys, because even though the market likes to range for 70% of the time, that 30% we could really capitalize on. Victoria says, is there a hierarchy of which indicators are more reliable, or is there a combination of specific indicators that are more reliable, or is it trial and error, whichever works for you? Yeah, Victoria, it's definitely a little more trial and error, and whichever works for you, because all in all, I personally don't use any of these indicators on a day-to-day basis, but if I'm doing a daily technical analysis, I might want to throw the RSI on there to match the higher highs, the higher lows. Same with MACD. But it's really all about trial and error, seeing what works for you. Does price action hold more weight than indicators and pivot points? So pivot points are price action, right? So the pivot points are the higher lows, the higher highs, and that is the price action we use. So I would always hold price action and pivots well above indicators. I would say it goes price action, pivots, and volume are the top three. And then right below that is going to be maybe the indicators to help us get the confirmation or to help us really read the market and understand what's going on. Alright guys, don't forget, hit that like button. It does take me a little while to put these webinars together, and I do like doing them for you, so I'm definitely not going to stop. I appreciate you all for tuning in today. It was definitely a very good one. I hope you guys all got to learn something. And if you guys got any questions, definitely drop a like, drop a comment, whatever you want. And we are a Bullish Bears community, and we're always welcoming new members. We go live every day for our members, so we trade ES, the NASDAQ, equities, all of that for you guys. So, and for our traders and for our members that are watching right now, I know we got a lot of new members lately that might not be too about the ES and NQ, who might not like futures. We do trade options and equities too, so always just remind us, be like, hey, listen, do you mind going over Apple today? Do you mind charting NVIDIA? And we're always down for that, always. Alright guys, any other questions, definitely leave it down below. Do appreciate you all for tuning in. Have a great day and have a great weekend.